Good morning and welcome to this Wednesday, March 24th, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, it's kind of a crazy day on Tuesday. We saw a lot of early strength. We saw some early strength, especially on the NASDAQ, but that faded and turned out to be quite a selling episode in the afternoon. And it wasn't just selling episode, but it was leaders everywhere that were getting hit. I mean, I saw leaders in small cap, leaders in large cap, leaders in technology, leaders in energy, just leaders seemed to be the ones that were all taking hits yesterday. Hadn't seen that in quite a while. Usually you've got leaders in certain areas that are doing well, but there were bounce back stocks. I mean, stocks like the at-home stocks, the ones that did really well during the pandemic, stocks like Peloton, Zoom, some of those types of stocks seemed to do pretty well yesterday. But really, for the most part, I was just seeing leaders being sold. So it'd be interesting to see how these stocks bounce back today. We are looking at futures up at last check. I can tell you, last thing I saw, Dow futures up about 100 points, S&P 13, and the NASDAQ leading on a relative basis up about 83 points on in the morning here as far as futures go. So it looks like we'll at least start off the day strong, getting back some of those losses from yesterday afternoon. But it'll be interesting to see whether or not we can maintain it. We are still in that historically challenged period from the 19th of the calendar month through the 25th. Today is the 24th, so we're getting ready to get through that. Unfortunately, maybe it won't play out this year, but unfortunately, March doesn't tend to pick back up again like a lot of the other months. When we hit the 26th, 27th, 28th, the end of March just is more of a blah kind of a period. Not really bearish, but not very bullish either. But the good news is we're only 1 week away from the start of April. And historically, that has been a very strong period for equities as we start turning our attention to earnings. We're still getting what I think are some pretty good earnings reports coming out. Winnebago had a really nice report. I think that was out this morning, or maybe that was out yesterday afternoon. I'm not really sure. Actually, I think it was out this morning. And we'll go through the earnings later in the show. But I think that theme still is going to play out. If you can grow your earnings rapidly in a low interest rate environment, I believe you're going to be rewarded in this market throughout 2021. And we're going to know more about that as we move into earnings season here over the next few weeks. All right, before we get into things today, let me go ahead and take you over to Earnings Beats for those of you who are new. You can sign up for our free newsletter, no credit card required. You can unsubscribe at any time. All you need to do, type in your name, email address, hit the subscribe button. Actually, today I put in a seasonality chart. So there's a lot of different things that we do in the free newsletter. But did a seasonality chart looking at the NASDAQ. And it's pretty amazing. I've talked about it on the shows, and I certainly have mentioned it many times to our members. But if you're not familiar with it, it's pretty amazing, quite honestly, how the NASDAQ tends to do extremely well in the first and second months of calendar quarters. So January, February tends to be pretty good. March, not so much. April, May tend to be strong. June, not so much. All the way throughout the year. This is the history of the NASDAQ and really just equities in general, but especially the more aggressive NASDAQ stocks. And I think a lot of it has to do with the hype around earnings. I think the first month of a calendar quarter, you're building up. You got a lot of pre-earnings run, buy on rumor, and then of course you're going to sell on that news later. And earnings come out on the technology stocks, many of the higher cap technology stocks, usually report starting around the third or fourth week of that first month, and then they carry into the second or third week of the second month. And so it kind of makes sense to me that because earnings are the big driver in the stock market over the long term, that as you start anticipating these earnings reports, you're going to bid these shares higher. And then, of course, they're going to come out. And over time, their earnings go higher. And so generally speaking, they're going to have fairly positive reactions. And then after earnings season, you just get into this period where earnings don't seem to matter anymore. Nobody even talks about them. The past earnings are done. The next earnings don't come out for another 30 days, 45 days, whatever. And so earnings just take a back seat. And then it's whatever else you want to talk about, which right now seems to be inflation and interest rates. And unfortunately, that has not been a good thing for the NASDAQ in particular, and for growth stocks. But I think that's going to change. We're going to find out as we move into April. But anyway, if you are interested in learning more about how we look at the market, that was just one example. The seasonality chart is something that provides education, I think, to all of our community members, which is really important. You want to be educated in making your financial decisions. But we'd love to have you there. If you want to try our service, you can click on the Join Today button. It's a no-cost 30-day trial. So you pay $7 up front to get you in the system. We refund you the $7. So you can enjoy the service for 30 days. One part of our, we do a lot of things, but it's hard to quantify our research. I can tell you it's very extensive, and we get a lot of rave reviews from our members in terms of the information that we provide. But the portfolio performance, this is how we look at the market using relative strength, using current themes to select portfolios. 10 equal weighted stocks go into each of our portfolios every 3 months. So February 19th, May 19th, August 19th, November 19th is when these portfolios are established, and we hold them 90 days. And the results since inception on all of our portfolios are higher than the S&P 500. And that's really our stated objective, is to beat the S&P 500. Now you can see we've got some work to do here this quarter. The market, the theme from growth stocks definitely shifted to value stocks, and that has had a major impact, not just on our portfolio, but any growth-oriented investor is going to get hit when the theme changes. Now, as we move back into earnings season, I believe the theme will shift back, but we'll see. Anyhow, this quarter's not been so good, but if you look at the since inception numbers, we're up on every one of our portfolios. So if you'd like to give us a shot, try us out for a period of time. Now's a great time to do so, and you can do it by clicking on that Join Today button. Let's move on to the action from yesterday. We had the Dow Jones Industrial Average down 300 points, still above the 20-day. And as you look across our major indices, all of our indices except for the NASDAQ are above the 50-day. Both the Dow and the S&P are still clinging to support at the 20-day. Mid caps and small caps are looking more at the 50-day. And the NASDAQ, even though we have strengthened since early March, we're still just kind of churning right here near this these two key moving averages. One thing I pointed out, I wrote a blog article yesterday, and of course, I've also put this in daily market reports to our members recently. But the NASDAQ, to me, when I believe we're in a secular bull market, which I think we're in right now, I look for continuation patterns. And so I look for bullish continuation patterns because I believe the stock market's going higher. I'm not going to look for bearish patterns if I think the market's going higher. So when I look at the NASDAQ, I've been kind of watching to see, at first I said, okay, ABC correction, which we got. And then as we came back up, we didn't fail at the moving averages. A lot of times in a downtrend, you'll fail at that moving average and drop again. Instead, we went through the moving averages and equal to that B, that bounce on the B, A, B, C correction. Well, that puts in a neckline. And then when we came back down, I remember even, when we hit that neckline, saying that a pullback to 13,000, I may have been looking at the QQQ or maybe the XLK, which is the technology ETF. But all these patterns look very similar. But I remember talking about the pullback potentially to mirror that left shoulder. And that's what we did in the NASDAQ. And then we rose back up. And so now we're kind of in, are we going to make the breakout above the neckline, or are we going to fail to hold this shoulder? So I think we're in a fairly important short-term trading range on the NASDAQ right now, between about 13,000 and maybe 13,700. And we're sitting pretty much in the middle of it, maybe a little toward the lower end of it. But with today's futures, it looks like we'll probably be back up in the middle of it. Where do we go from here? I think if we can continue to hold this over the next week, I believe we make the breakout as we move into April and start heading toward earnings. That's what I would look for. That's what I would expect. That's what I expect from a secular bull market. I expect consolidation from time to time. This isn't bad. A lot of folks think, oh, technology's dead. I don't believe that at all. I think technology, which led significantly in 2020 and into the early part of 2021, especially in 2020, though, I think we saw a pause. And a lot of folks, I think, are writing technology off prematurely, but we'll see. And I think the first clue is going to be how these stocks react as we start heading toward earnings. So watch this as we open up April. Mid caps, small caps, both came down. These two areas have been pretty weak of late. The weakest area over the last 10 days, I'd say for sure. Can we hold these 50-day moving averages? I mean, look back over the last several months. That's, we haven't broken back below the 50. So I would expect to bounce here, but we'll see. Looking at the leadership on Tuesday, notice the three groups that went higher, the only three sectors that went higher yesterday: utilities, consumer staples, real estate. Now, on a down day, that's not unusual. I don't want to even say, well, you said when defensive groups lead, that's bad for the market. When defensive groups are carrying the market to the upside, that is bad. You don't want the market breaking out to new all-time highs and being led consistently by defensive groups, because what that's telling me is that money is rotating into more defensive areas as we're breaking out. That's not good. But when you pull back, normally money's going to get more defensive. And, when I think about the growth stocks and how the leaders really took a hit yesterday, I think this maybe exemplifies it more than anything. Just the only thing that seemed to matter yesterday was defense. I mean, we had money going into treasuries, yield was coming down. We had money going into utilities, staples, real estate, and just about everything else was selling off. The dollar had another good day. I'm going to talk about the dollar in a couple minutes, but that led to materials having a rough day, losing more than 2% yesterday. Aluminum down almost 10%. Aluminum is your number one industry group prior to yesterday, the number one industry group since last year's March 23rd low. Number one out of 104 industry groups. Yesterday, down 10%. That's what I'm talking about. Leaders everywhere. It wasn't just, our portfolio stocks, which had a rough day. It just seemed to be whatever has been working did not work yesterday, and significantly did not work yesterday. Like I said, aluminum down 10%. That's huge from, looking back at what we've been doing and how rapidly. I mean, if you look back, you might say, well, it looks like it's going up about the same as the others. Look at the scale over here on the right. Aluminum back in October was less than 40. It went up to almost 120. That's 3 times in 5 months. So clearly it was a leader, but it took a big hit yesterday. All right, let's move on. 10-year Treasury yield. Talk a little bit about economic reports. There was really only one significant economic report. We had February durable goods come out, much less than expected. I will say durable goods tends to be highly volatile from month to month. I don't really follow it that closely because of the volatility. If I were to follow it more closely, I'd probably want to smooth it out over 3 or 4 months, maybe even 6 months, to get a better sense of what durable goods are doing. Because one month it'll be 4 percentage points above the estimate, the next month 3 percentage points below it. And so I don't really get a good feel. But anyhow, the numbers: February durable goods declined 1.1%. The market was expecting a rise of 0.8%. And if we strip out the transports, then durable goods fell 0.9% versus an expected rise of 0.6%. So the number's not very good. And by the way, economic reports this week have not been strong at all. Existing home sales were horrible. New home sales horrible. Now we got durable goods horrible. But Jerome Powell's been kind of making his way around speaking this week, and he continues to talk about how economic activity looks much stronger. So keep in mind what we're looking at is in our rearview mirror. We're getting ready to head into April, and here we are talking about February economic reports. But, I think what I would do is focus more on what the Fed is talking about, because that's going to be what ultimately dictates what happens to interest rates and to Fed policy. You know, does it stay accommodative? It's going to be based on what the Fed's seeing, not what we're seeing in the rearview mirror. All right. But anyway, 10-year Treasury yield you can see coming down. I think that's a good thing. Short term, pulling back. Ultimately, I do believe we go higher in the 10-year Treasury yield. I think with the growth that we're expecting, I think there's going to be a lot of selling of 10-year Treasury bonds. And so I expect this 10-year Treasury yield to go up into the twos, maybe even well into the twos before the end of the year. I don't believe, like most, that that's going to hurt the bull market or crush technology stocks, not with a GDP of 6.5. Now, if GDP all of a sudden only comes in at 4 or 4.5 instead of 6.5, then we're going to have problems because this market is building in valuations based on growth. So if you don't have the growth, then higher interest rates obviously will have a negative impact. So something to keep in mind. It's really the combination. If growth forecasts keep getting, moved higher, we can have the 10-year Treasury yield move up and move up fairly significantly from where we are. We could double from where we are and still, in the long-term scheme of things, at 3.25%, that would still be way low on a relative basis. So you got to keep things in perspective. A 2 or 3% Treasury yield is not going to crush or slow down an economy that is set to increase very significantly later in 2021. All right, let's talk a little bit about the dollar. And this is a chart I bring up quite often. Talked about it last night briefly in our Changing of the Guard webinar. But 10-year Treasury yield in the U.S. versus Germany, we've been talking a lot about the Treasury yield going higher. One thing you're not hearing in the media, or at least I'm not seeing any news headlines about it when I do go to CNBC to check out futures or whatever I do. One thing I'm not seeing anyone talk about is the fact that U.S. interest rates are moving up so much faster than other areas around the world. To me, that tells me that the economy in the U.S. is going to be stronger. It's going to pick up and be stronger than other parts of the world. What does that mean? Well, that means typically that you're going to have a stronger currency. So this is just a chart showing you U.S. yields minus German yields, 10-year Treasury yields. And you can see over time it's been moving up. This doesn't mean that they're both going higher and that the U.S. is moving higher faster. This just means the difference between the two. During part of this time, both Treasury yields were coming down, but U.S. in most of the instances was coming down. The yields were coming down slower than Germany. Germany's were falling faster. So the difference between the two was rising. So you have to understand this is the difference. So don't get confused and think, well, interest rates didn't rise through all these years. No, they didn't. But the U.S. versus Germany did. And as a result, you can see what the dollar tends to do. The dollar tends to follow this ratio pretty remarkably close. I mean, I was just looking at this one day and happened to find, I don't remember how I stumbled upon it, but it's like, wow, this is an interesting intermarket relationship that we need to watch because it tends to predict what's going to happen to the dollar and tends to predict it very well. Well, if you look over the last several months, this ratio is climbing rapidly. The dollar kept going lower, and now the dollar is finally starting to turn back up. That's the history. If you go back and you look, these green shaded areas represent periods where U.S. rates are moving up faster than Germany's or moving down slower. The difference is moving up, and yet the dollar kept going down. So you created this inverse correlation. In each of these situations, the dollar has come charging back. And so I think that's what we're starting to see now. And so when folks hear me say, I'm not a fan of energy, I'm not a fan of materials, it was the same thing that I was saying a year ago with gold. It's not that I don't think energy can go up or that materials can't go up. What I'm concerned about is in a rising dollar environment, which I believe we are just starting and that we're going to have in 2021, materials and energy tend to underperform. And I mean, I've got the charts to back it up. Now, maybe this is going to be different. Who knows? But when the dollar was weak back at the beginning of the century, 2001 to 2008, you can see the dollar was steadily going down. Energy outperformed. This is a relative chart, energy versus the S&P. Energy outperformed, materials outperformed. Commodities led that rally or relative rally back in the first, 8 years of the century. Then we went through this period where the dollar just couldn't quite figure out what it was going to do. Well, neither could energy and materials on a relative basis. And then we put in this double bottom on the dollar, and the dollar started rising. Well, look what has happened to energy and materials. On a relative basis, they're going down. Now, if you've been following materials, you know materials have been going higher on an absolute basis. And while the dollar's been coming down for the last year, materials have been leading on a relative basis. But if the dollar turns back and goes to the upside, I think we have history on our side to say you want to be really careful with materials. I mean, if you look back, we had rates go down in 2013, 2014. And when that happened, 2013, 2014, materials led. As soon as we started moving back up in the dollar with the dollar again, materials got hit. So if you believe what these charts are telling you, I do. I believe that there is a reason why our yields in the US are going up faster than Germany's. I think it's because our economy is stronger. If our economy is stronger, our currency should strengthen. And when the currency strengthens, materials and energy underperform. That's been the relationship. Now, if you want to bet against that, if you think I'm wrong on the dollar, or you think it's not going to matter what the dollar does, then be my guest. Go into energy, go into materials. I'm just pointing out what the charts are telling me. And I try not to argue with the charts. I'll argue with the media all day, but I'm not going to argue with the charts. Let's keep moving. So Intel came out with some news. They're going to be building 2 new plants in Arizona. They're going to invest $20 billion in these 2 new plants. They did up their guidance for, I think, this upcoming quarter, but lowered it for the year, if I recall correctly. And the reason that they lowered is they blame chip shortages. Hence, they're building new plants. Now, the real beneficiaries, and we're going to watch and see what happens to Intel, see if we can get this breakout, because looking at this longer term chart, you can see the importance of 67, 67 and a half. So if I pull up the pre-market on Intel right now, knowing 67, 67 and a half, big level, we're up 66 and a half. We're up $3 today. So good news is that Intel is going to build these plants. The market's reacting positively to this investment. The bad news is we're now right up against this resistance. Can we get through? We got positive news. We're getting the gap up. I think it's going to be really important to see this follow through today. If we see, if we see gap up and failure and we come back down and go negative today, or even just, trim our gains quite a bit, I'm going to think maybe short-term Intel's topped. The overall chart looks good. I love semiconductors. So I do think we're going to break out on Intel. The bigger problem that I have with Intel is just the longer term relative strength. I mean, you can see Intel versus semiconductors had been coming down. We're starting to show a little bit of strength here over the last 2 or 3 months, which is great. We need to continue it. And in order to continue it, we've got to get this breakout. So that's going to be the challenge for Intel. When I look at the accumulation distribution on Intel, I see a lot of negativity here. So what you have to be careful about is when you get the way you get negative accumulation distribution is when you gap up. Look at this in January, we had this huge gap up and then we sold off, and then we had multiple big red candles closing near lows. That's how you get this AD line to go down. The way you get it to go up is not through gap ups, but through buying during the day. And so, yeah, the gap up's nice. The news is nice, but Intel still has a lot to prove in this space. And that's what I just wanted to point out. Small caps, I mentioned at the beginning, small caps struggling. You can see the last 7, 8 days or so, been pretty rough. We've gone from 1,400 down below 1,300. So it's been about a, 7, 8% correction on the small caps. And that may continue. But what I'd be watching is, number one, the 50-day moving average. But I think even more important than the 50-day moving average is going to be this price support area. So notice the top that we set back in January. We pulled back and then we broke out. Well, since breaking out, we've gone back twice, 2 consecutive days earlier in March, and tested, and that's down around the 1250 area. So losing the 50-day, while that would be horrible. I mean, we lost it here, we lost it down here, we lost it over here, and still we bounced back. What I'd be more interested in is this price support level. So the 50-day, yes, it's important. I'd rather see it bounce off the 50, but if it goes down a little bit below the 50, it's probably going to trigger a lot of selling and an opportunity for institutions to accumulate if they so choose. So I would be watching 1250. I think if you start moving to 2-3 month lows in a market environment that's still pretty strong, that would be a little more concerning to me on small caps. So kind of keep an eye on that. Next thing with small caps is, I've got a chart list that we provided to our members, and it's all of the key sectors, the small cap area within each of the sectors. So for energy, it's like the PSCE, which is small cap energy ETF. Well, I took the top 10 holdings out of that PSCE and put it into this chart list. And then I took the top 10 holdings of the PSCT, which is technology small cap ETF, took the top 10, put it into here. Well, now you can see we got a lot of stocks because I did this with all the sectors. So you can see all these different, and you can see the industry groups down here at the bottom. And you can see mostly the green, which are up in the leading quadrant. Look at what primarily comprises that. It's mostly energy. So 1, 2, 3, 4, 8 energy. So of the 10 energy stocks in the PSCE, 8 of them are in the leading quadrant. Now that's using the benchmark of the SPX. I'm going to change that to the SML and update. And you can see everything just kind of shifts over. Why? Because over the last year, small caps have been stronger. So everything's going to shift over a little bit weaker to the left side if you're comparing it to the SML. Versus the S&P 500, everything looks much stronger because small caps have been outperforming the S&P. Now, what do you do with this? I mean, you got stuff every which way. Well, there's a couple of things you could do. You could create a new list and just move, maybe if you just wanted to look at energy, you could move those 10 energy stocks into a new chart list and then bring that up on an RRG. The way I did this let me just go back to it. Let me show you how I did this. So you go in and you grab your chart list. So if you've downloaded this from our website, Small Cap Leaders, and then you view all, and then you just change this to RRG. And then it comes up with the benchmark being the S&P 500. So you have to change that. That's how you get to this. Now, I'm interested in these stocks on the right-hand side of the chart. This is the relative strength going across here from left to right. So, and from bottom to top, it's momentum, relative strength this way. I am a relative strength fan. So I like these stocks that are way over to the right. That means they had tremendous relative strength. Now they're weakening, which probably means they could be at a good area for, maybe a entry. So everything that's yellow is in the weakening group. So I'm looking at something like, all right, so I'm looking at, I don't know, maybe CPRI is a stock that I really like. It's been getting hit a little bit lately. But if you come down here, you can look and see so let's say you're a consumer discretionary fan. There's your CPRI. You got Shake Shack in this group, Crocs, Shoe, and Asbury Automotive Group, ABG. All of these have moved into the weakening. Now, most of them you can see were nice relative strength leaders. So what you can do is, let's say there's one in particular, like Capri. If you click on this right here, look what happens up top. It highlights it, which is kind of cool. So you can then follow it. I can grab this and go back and see how Capri has gone over the last year. Look at the strength of that stock. And now it's weakening, but a lot of times that provides you an opportunity. So if I were to go up here now and pull up Capri, I could see on a chart what's going on. Well, there's your weakening. That's your relative weakening. And even through here, it was probably weakening. It was going up, but it was going up much slower, or even all the way through all of this. Here was your strength. And then you started seeing the weakening really by going sideways. And then we broke out again, and we've come back down now and tested this breakout area. So I would argue, hey, if we're in a secular bull market and we like consumer discretionary, and if we pull this up on a relative chart, you can see Capri has been one of the leaders in the clothing and accessories area, pulling back a little bit. This could be a great opportunity. So this is how I would use the RRG charts to kind of help us look for a potential investment. Now, you might look at this and say, well, yeah, but I don't like the AD lines coming down. We lost the 20-day. I'm going to hold off to the 50. Fine. My point here is that this, using the tools at Stock Charts and the research that we provide, hopefully you can help to narrow in on some smart choices. Now, does this guarantee that Capri is going to go higher? No. Capri could break down. Capri could go back down to 30, 20. I don't know what Capri is going to do for sure, but I know right now it's been a leader. I tend to stick with leaders until they prove me wrong. So I would be watching this price support area, gap support, 50-day. I think, maybe even those tails down to about 45, maybe give this a little bit of room. But if you like the stock and you like this leader, then maybe you begin to accumulate it. It was almost at $60 end of last week. I don't know if this is an optionable security, so I don't know how much of this could be option related, but it probably isn't heavily traded if it is at all in options. But this is a stock now that's pulled back $10 in 3 days. $10 out of 60. I mean, we're talking 17% of its market cap gone in 3 days. As a short-term trader, this is what you look for. I don't want to chase a stock. I'd rather get one in a pullback. Anyhow, I thought that was an interesting chart. Earnings, we'll go through just quickly on a couple of these. Adobe reported they beat top and bottom line. They raised guidance for the next quarter and for the fiscal year. Revenues, earnings per share, everything. Let me give you a quick update here. See where we are. We gapped up, still unable to go through the 50-day. And Adobe, with that great report, beat top line, beat bottom line, guides higher. For whatever reason, Adobe is just not a favorite right now. I can't explain why. Look at Adobe relative to software stocks. It's been going down for 7 months. I mean, I could beat my head against the computer and say, why are we not going higher on Adobe? It's another great report. We gap up and we're up fractionally. We're up 0.15%. How's that possible after this? Well, maybe the market feels like there was so much growth already built in. Look how much Adobe went up. And that's the thing folks get a lot. They get very impatient when a company has a big move and then consolidates, because you always want to make money. I think Adobe will be fine in time, but right now it's not showing leadership, and it hasn't been showing leadership since August. At least let's get through the moving averages. We can't have an uptrend until you get through the moving averages, and then you want the 20-day above the 50. I mean, that's your uptrend. Once you start moving, but above, below the moving averages, you're not trending anymore. And so step one for Adobe is to get above the moving averages and have the 20-day climb back above the 50. And then when you pull back, hold those moving averages, just like we did here. Hold them and keep rising. That will tell you you're in an uptrend. So for now, I think Adobe, great report. Congratulations. A little golf clap. Awesome. But market doesn't care yet. So we'll see if they care later today or maybe in the weeks ahead. But right now, the market doesn't care about Adobe. And that's honestly what the market has been saying about growth stocks for the last 6 weeks. We just don't care. When we break above, we start trending higher, we'll have a different market to talk about. Another company that I thought had a really good report, and you can see is down 3.5% today. This was At Home. Easy beat top and bottom line. Bottom line, $1.08. Market was expecting 69 cents. They came in at $1.08. Market pulls back. Now, why would it sell off? Well, this is a stock that at the beginning of the year was $15. It just went to 35. Why does technology come down in March? It's because it gets bid up during earnings season and it comes back down. Buy on rumor, sell on news. Same thing with individual stocks. Now, it doesn't happen every time, but when it does, that's generally going to be my answer. It's going to be buy on rumor. News is out, sell on the news. Still great stock. And I think if it pulls back 20-day, maybe even down to price support around 27.50, I think that's a stock that would look very attractive to me. Again, when you're looking at relative strength, look at it versus specialty retail. Specialty retail I've been writing about lately, trying to make a breakout. So maybe if we get a little pullback in specialty retail, get a pullback in at home, that'll be an opportunity for maybe in the next push as we move into earnings season. One other one. Well, let me pull up Winnebago, because Winnebago had a really good report. Let's see what they're doing. It's up, but it's up 3%. It's in a downtrend. It looks to me like it still wants to go down to 75 to test this breakout. I love Winnebago. I really like this chart. The relative strength you can see has been picking up versus recreational products. Recreational products has broken out. But again, we went from $67 to $87 in about 2 or 3 weeks. So it's pulling back. 75 is great support. Last one I'll pull up is General Mills. So this is more conservative. They came out, they missed on their earnings, 82 cents versus 84. They did beat on their top line, but you can see the stock down 4% back to its 20-day. And this has just not been a stock that's going to benefit a whole lot from a market that really has been, up until the last 6 weeks, like I said, has been favoring growth stocks. So yes, recently with the move into value, you can see we've had a couple of runs to the upside, but this is just not the kind of stock that I want in a high octane growth market with fairly low interest rates. I just don't think General Mills is going to be the type of company that's going to be rewarded over time. Still a great company though, long term, pays nice dividend. It's fine for many investors that want to be more conservative. Obviously, this has been a much better stock in March than our growth stocks. So it depends a little bit on the theme of the market, what's going on in the market as well. All right, last thing, just take a look at the 3 you must see. So what I'm going to pull up first is these were the top 3 mid-cap performers yesterday. So I just thought, I haven't even looked at the chart yet. I just pulled them up off of the, when you go down here to, here. I pulled them up from yesterday. They're showing, I guess, today's. But yesterday, the top 3 were NEOG. So let's pull this up on a relative chart. NEOG, which is just going sideways. Big day yesterday. Not a whole lot of volume. Very little today, only 3,000 shares. Maybe I should have vetted this for volume. But I see, mostly sideways for last year. I don't see a whole lot of growth here. It's in medical supplies. Medical supplies been pulling back. It's not a leader. I would ignore a chart like this, even though it went up yesterday. This isn't the type of stock I would be interested in. Sprouts Farm Market. Okay, definitely strengthening. Nice volume trends. AD line could use a breakout. I'd like to see that breakout above these tops here. On a relative basis, stock has definitely been improving last couple of months. So this is kind of the new wave, if you will, of what's been working in the market recently. So I think a stock like this on a pullback to a 20-day test would be a very interesting stock from a short-term trading perspective until it breaks down. As long as it stays strong, and especially if we get that breakout on the AD line, I would begin to look for the stock maybe to make a push back up toward 28. So this one looks pretty good to me. Last stock, then we'll wrap up. I know we're running over a little bit here. Strategic Education, AD line, I'm not favoring. Look at this stock. Okay, yes, it had a good day yesterday. I'm just not seeing anything on this chart that looks appealing to me. So I'd personally pass on it. All right. Give you a quick update on the market. Dow up 215, S&P 18, NASDAQ, which was showing a little bit of leadership, is not showing that leadership right now. So maybe we're getting a little bit more of that rotation here as, we are here in March. This is a difficult time for many of these stocks historically. Certainly has been this month for sure. But we'll see how things, shake out rest of the day. And of course, like I said, 1 week away from moving into April, which I think I'm expecting it to change in terms of our leadership as we go into that pre-earnings period. Anyway, everybody have a great day. I'll be back tomorrow over at Stock Charts TV for the next Trading Places Live, although it's technically pre-recorded. But that'll be at 9 a.m. Thursday morning over at Stock Charts TV, and that's Eastern time, of course. Hopefully you can make it. In the meantime, everybody have a great day. Happy trading.